Good evening, all. I welcome you all to this weekly webinar called Vichar. It's an initiative of Federation of Indian Association of Victoria. My name is Surya Soni. I'm former president of FIV as well as current trustee of FIV and AICCT. This is an initiative where we bring local talent from the community in Victoria and share our knowledge in diverse fields. We learn from each other, we share with each other, and there's no promotion as such. We're just sharing the knowledge in these webinars. So if you know any talent in the community and you want them to participate in this webinar, please recommend it to me, and also share the flyer um, of these weekly webinars to your friends and families, and also ask them to join this WhatsApp group for notification and updates on about next webinars. Next week is next Wednesday is right in middle of two long weekends, so we'll skip next Wednesday webinar. But a week after, we would have a interesting presenter coming in on storytelling. She runs her podcasts and she will share her experience from many years how to run your own podcast, what are the learnings and what are the pitfalls and how to avoid, how to make it a successful webinar, podcast, and what is the art of storytelling. Today we have our speaker, Benjamin Fernandes. Welcome you, Benjamin. And so kind of you to share your knowledge on superannuation. I'll give you a brief introduction of Benjamin. Benjamin is a certified financial planner with almost 2 decades experience as financial advisor with industry funds like Big Super, Legal Super. Benjamin specializes in superannuation and retirement planning. Currently working with Legal Super, Benjamin advises high net worth individuals like lawyers and barristers. Benjamin lives in western suburbs, is active in local community, the church in Point Cook, and Goan Association. Benjamin is married with 2 children, around 30 years old, plays badminton locally, and is a keen sports enthusiast, watches cricket, soccer, tennis, and supports the Western Bulldogs. Welcome, Benjamin, and without further ado, over to you to share your knowledge on superannuation. Thank you.
Thank you for those kind words and a great introduction. As any financial session should start, I will start with a bit of a disclaimer stating that the session today is an information session only. There is no advice. At best, I can provide you some general advice. And at the end of the session, also, when I take questions, if the questions stray into personal circumstances, I have to answer it in a general manner. So keep that in mind, that it is without taking into consideration your financial objectives, needs, and goals. And for that, you need to seek specialist and personal advice one-on-one, certainly not in a public forum of this nature. How does all of that sound to you? I think it has to be accepted.
Yep, thank you.
Okay, so we are talking today about superannuation, something that I eat, drink, and breathe every moment. It's very dear and precious to me, but it is a very complex subject and a very vast topic. So in the time that we have, I will try to share as many things as I think important and relevant. However, I also will allocate a decent amount of time for questions. So I want you to have the opportunity to have what you want answered as an answer for your questions on superannuation. So we will have a decent amount of time for questions. I will cover most of the topics which are general in nature. Let's start by understanding what is superannuation. As basic as that. It is a forced saving for retirement. So it is compulsory, it is mandatory, it is legislated. The current rate that an employer is required to pay is 11.5%. And that increases to 12% on 1 July. Good news for every one of you. You get a pay rise. And if I quote any examples and I do some quick calculations, I will be using the rate of 12% because that is easier to calculate. And some of the examples make mental maths, which I do more easier rather than 11.5%. It's turning to 12. So any example that I do will be with 12%. Employers are currently required to pay to a super fund. They pay monthly, they pay quarterly, some pay fortnightly. But what does the legislation require them to pay? Legislation requires them to pay it no later than the 28th day after the quarter is over. So for this current quarter, April to June, the latest that they have time to pay is 28th of July. I am covering this and giving these facts to you because I see many people being ripped off and not paid super and do not know when it is to be paid and how do you question it. So yes, they have some time. And the government acknowledges that employers turn bankrupt, do not pay super, and when ultimately they go into administration, they discover super is not paid. So the legislation is changing. And from 1 July 2026, it is changing to be done straight in every pay cycle. So whether if you're paid fortnightly or paid monthly, it will be 10 days after the pay cycle is over that the super has to be paid to the super fund. So no longer should people be not paid super or shortchanged and the company closes down or turns bankrupt. So that's some general rules about super. For an individual, there are various types of funds. You hear about these terms. What are the different types of funds? I'll briefly touch and explain some of them. So the first type of fund is an industry fund. And I think a majority of the population is in an industry fund. Industry funds are not-for-profit organizations. They have simple products and they have no shareholders. With the result, they probably have lower fees. Organizations that I have worked for, Vic Super, Legal Super, are both industry funds. Other big names are Australian Super, Rest, Hostplus, Hester, Cbus. All of them advertise a lot of TV. You would have come across them at various times. So those are all industry funds. Anyone can, they're not confined or restricted to a particular industry. They're open to anyone joining. Everyone wants to grow. Everyone wants to have a share of the pie. The pie is big. It's $4.3 trillion. So they want to grow. And some of the big funds have more than 200 to 300 billion. The next type of fund is what is called retail funds. These retail funds are owned by banks and other ASX listed companies, examples of which are like AMP, Insignia, which used to be previously IWF, MLC. So a lot of mergers and buyouts have taken place, and they have now come up with some new names. Mercer is another retail fund. They offer more sophisticated products and a wider choice of investment. A wider choice sometimes makes them more complex and difficult for a layman or an individual person to understand and make a choice. And therefore, they're usually set up by a financial planner. And you are in the hands of the financial planner to make any and every decision with regard to your super in a retail fund. They also likely to have slightly higher fees because they are organizations which need to make profits and they need to have shareholders and to satisfy dividends. But they are becoming more competitive, and like the hope is that even if they charge higher fees, if they can produce higher returns, then I am better off. So they're not necessarily a bad thing to have that you have an industry fund or a retail fund. It is like you got to look at ultimately the fees that you pay and the returns or the performance that you get, and also the service that you can get from a fund. Help and advice at what cost and how good it is. And well, if it is free with some industry funds like I have worked with, then it can't get better than that. Lastly, the third category of funds where people are wanting have choice and control are self-managed super funds. Individuals do not sort of get satisfaction from their money being managed by either a retail fund or industry fund. They think that they can do better themselves. I deal with a lot of these personalities. I deal with a lot of lawyers and I deal with a lot of barristers. And they like choice and they like control. And therefore, a lot of them do try and set up a self-managed super fund. It's not a bad thing to have. It is a good thing if you want it, if you know what you are doing, and if you would like total choice and control. In a self-managed super fund, you are an individual member is the trustee and is responsible and accountable for any and every action that the super fund takes. And therefore, the trustee responsibility is one that has to be taken seriously. It is if the regulators find that the self-managed super fund is not being run in a compliant manner, they may deem it to be non-compliant, and then the tax rate emerges to be the highest marginal tax rate. The question that I often get is, should I start a self-managed super fund? There is no right or wrong. And what is the associate question is, what is the minimum required to start a self-managed super fund? It depends on what you want to do. If you want to invest in shares, if you want to invest in property, those are the common ones where is the reason why you would like to set up a self-managed super fund. And well, these investments, if it's a property, it probably definitely cannot be lower than $800,000. So you need to not have all of that money, but the lending is much lower for a self-managed super fund. Most banks will only lend up to 70%. So a general figure talked about in industry is that you should have at least $200,000 to $300,000 as a couple if you're thinking of commencing a self-managed super fund to invest in property, because then the borrowing can be achieved to achieve a decent property. Also, there are huge costs. An industry fund or a retail fund, your overall cost is generally around 1%. On a balance of $200,000 to $300,000, your cost is $2,000 to $3,000 with that industry fund. And a self-managed fund would incur the similar cost for the accounting and auditing that needs to be done. There are other setup costs, which are one-time costs, which are a little higher. So therefore, broadly as a figure, 200 to 300,000, desire to have control and desire to invest in property. Property is an asset class which has done very well, and people often get tempted that I can make more money in property than what the super fund can do, and therefore, and yes, to some extent, it has been true in the past, and it also has some concessional tax treatments as well, and it is quite lucrative. But I would encourage you to get specialist advice if you are attempting or thinking on those lines. These are some broad guidelines to take into consideration. Next, I'll talk about contributions that are made into a super fund or your own super. Basically, in the beginning, I talked about an employer making contributions and the rate being 12% from July. That contribution is called a superannuation guarantee or an SG contribution. Okay, so that is the first type of contribution which everybody gets. A superannuation guarantee is required to be paid by every employer at the rate of 12% from 1 July and is classified as superannuation guarantee. It also then falls under the umbrella of what is called a concessional contribution, simply because it does not get taxed at your marginal tax rate, but gets taxed only at 15% when it hits the super fund. In addition to employer contributions, you are also allowed to make voluntary contributions into super. And the main type of voluntary contribution that is made for tax benefits is a contribution called salary sacrifice. I will explain how salary sacrifice works later in the presentation, but at this stage, suffice to note that it is also a concessional contribution in addition to the employer contribution. And lastly, if you're not employed, if you're self-employed, if you're not employed by an employer but self-employed, and you have no salary, you can't make salary sacrifice, you can make a similar contribution as a personal deductible contribution, claim a tax deduction which is exactly identical and be exactly on par with an employee who is employed and doing salary sacrifice. So you make a personal deduction, you inform the fund that you're claiming a tax deduction, you lodge a form called notice of intent, you get a confirmation from the fund, and it comes in your ATO pre-fill as a deduction available to you for contributions to super. So these are the three types of contributions which are classified as concessional contributions. There is a limit of how much of a concessional contribution can you make in a financial year. and the current limit is 30,000 in a financial year. So if you are on a wage of, say, 100,000, 12% is what your employer contributes, would be $12,000. You have scope to do a further 18,000, and that would total to 30,000. The 18,000 that you choose to salary sacrifice or make as a personal deductible contribution is taxed at only 15%, whereas your income on 100,000 is taxed in the 30% plus Medicare bracket. And therefore, you see, the deduction helps you to reduce your taxable income, pay tax at 15% rather than your marginal tax rate. I will explain the strategy again a little later in the presentation, but that is the benefit of being taxed at only 15% for contributions going into super. All contribution, the salary sacrifice, the personal contribution, and the employer SG is taxed at 15%. The next type of contribution that you're allowed to make into super is termed non-concessional contribution. This is money sitting in your bank account. The amount is either from a sale of a property, sale of shares, inheritance, lotto. Why would you put it into super? It doesn't have the 15% tax, but it helps to build and boost your super. If invested in a term deposit, it may earn 5% on a 100,000 deposit, but that 5,000 gets added to your taxable income and taxed at your marginal tax rate. Whereas when it's put into super, it is taxed at only again up to 15%, the earnings. So therefore, that is the benefit of putting non-concessional contributions into super. Both concessional and non-concessional contributions are preserved. What I mean by that is that they are locked away in super till you meet a condition of release to take the money out, namely attaining age 60 or retired. So you must be aware that money put into super, once in there, is pretty much locked away. That is the reason why super is attractive. If it was allowed to be taken, there may be nothing there at the end. And second, it gets the benefit of compounding interest on interest. And that's if something is started at age 20, when you attain age 60, it has 40 years to gain interest on interest, and that's how its growth is achieved. After 60, all withdrawals from super, whether in form of a lump sum or taken as a pension, are completely tax-free. So the advantage of income in retirement, gross is net. If you have $500,000 and you take a pension of whatever, 5%, the 25,000, there is no tax on it. Nothing of it goes to the government in comparison to your current salary. The full payment from super, whether in form of a pension or a lump sum, is completely tax-free. I will not be talking too much today about pensions, just touching upon it, but this point is to be noted that when you're getting these tax incentives when going in, paying tax at only 15% and no tax when it's coming out, are what makes the system very attractive. Of investments in super. My son went to work for a small self-managed super fund company when he was in uni and came back saying that they have 10 million, 40 million in self-managed super funds, and it's better than a Cayman Islands. The next thing about super is something which is a little bit morbid. In the event of death, you're allowed to have a nomination with your super as to who you want the money to be paid in the event of any unforeseen event where you pass away. You are allowed to have, super is a non-estate asset. It does not form part of the will and can be paid directly to a fund. Go online and check, or go to your last statement. Nominations are of two types. There is something called a binding nomination, which the trustee must pay to in the event of a valid nomination. The beneficiary for a binding nomination can only be a dependent. A spouse, wife, partner de facto, and children can be listed as beneficiaries in a binding nomination. The other nomination is a non-binding nomination. A non-binding nomination is an indication to the trustee as to who you want this money to be paid. Your wishes will be taken into consideration in the event of a non-binding nomination. But if there is a claimant or a challenger in form of, in today's world, complex situations like second marriages, stepchildren, the trustee has to give some of that consideration for a non-binding nomination. Ultimately, who it is to be paid may be decided not by the trustee, but the point being that a non-binding nomination has to, a claimant, if there is a claimant, the trustee has to give that consideration. If you have no immediate, if you are a single person, no partner, no children, you can nominate brother, sister, father, mother, but that can't be a binding nomination. It can be a non-binding nomination, and it is unlikely that there will be a claimant or a challenger. So those are the two types of nominations. I would encourage you to give some, go through your paperwork and see whether you have a nomination in place. And if you don't, I would encourage you to put one in place. The next topic I'm going to talk about is insurance. You can have some life cover, total and permanent disability cover, and income protection cover within your super. Life cover is pretty straightforward. It's life if one were to pass away. The additional amount that is held as insurance is paid together with the balance. Funds offer different types of life cover. There is unitized cover, there is fixed cover, and as you grow older, the cost of this cover increases, and in some cases, the cover reduces. This is pretty logical because a human being, as you grow older, you are more prone to disease. You're more prone to disease in your latter life than in your 30s and 40s, and therefore the costs become higher. The need for insurance is also high in your 30s and 40s because that's the time when you have some debts and your dependents, your children are young. And you, if anything were to happen to the individual, there would be a severe financial impact on the remainder of the family or the dependents. And therefore, the need of insurance is very high in your 30s and 40s. It slowly diminishes as you begin to acquire more assets and you reduce your debts. And lastly, your children become adults, and in your 60s, probably they are independent. And theories say that the need of insurance almost diminishes, probably becomes not required, but not everybody subscribes and agrees to that. I'll leave it to you. But the point is that it is not a wealth creation strategy. It is a risk mitigation strategy. And the risks are highest in your earlier part of life when you have debts and dependents. Total and permanent disability is another form of insurance that you can have. It's simply a lump sum that is paid if two doctors certify that you are never able to work again due to major illness or injury. Common examples in my career that I've seen are people diagnosed with cancer, stroke, and sometimes accidents, which prevent them from never being able to work again. And in that event, the total and permanent disability amount insured can be paid out. The last type of insurance that you can have with your super is income protection or salary continuance, also is commonly called. It is that you are unable to work due to illness or injury. It's not paid if you were to resign or you are made redundant. You're not covered for that. Temporary disability while playing sport, injured, are the examples where income protection can be paid. Income protection, the way it is structured, has some choices. You have the choice of a waiting period, the common examples of which are 30 days, 60 days, or 90 days, and also the duration of the benefit period that you want to be paid. It is 2 years, 5 years, in some cases, age 60 and 65. Most common that I see is commonly 60-day waiting period and 2-year benefit payment period. Okay, that's about insurances. Now, the common question that also does come associated with this is, should you have insurances? Some of these insurances you have outside super available to you as well, and people do take up those. Should you have it within super or should you have it outside super? I'll tell you the pros and cons of each and help you make an informed decision. In super, the premiums tend to be cheaper simply because they are negotiated on the entire membership base of 100,000, 200,000, a million members, and therefore they get better rates. There is no middleman involved. Insurance is usually sold through a broker, and it involves hardcore selling, and they are paid hefty commissions. When through a super fund, there is no middleman and no commissions. Lastly, the premium is also paid from pre-tax dollars, from your income before tax, rather than having to pay tax on it and then have it outside super. So it makes it advantageous to have it within super. It comes at a cost that it reduces your retirement balance. And for income protection held outside super, it is tax deductible. But all these premiums that are paid from within super, none of which is tax deductible to an individual. So therefore, it is advantageous to have it within super, but in some cases, depending on your personal circumstances, you may find it better in the option that you choose outside super. The next topic is probably the most important and will decide how big your retirement nest egg is, and that is the choice of an investment option. So the two biggest factors are contributions that are made into your account and how much returns it produces. Now, the returns it produces is dependent on the investment option that is elected or that you are put into by a financial advisor. When you go to see a financial advisor, they do what is called a risk profile analysis. They ask you various questions as to what is the return you're seeking, what is the time frame of your investment, how comfortable will you be if your investment were to drop 10% each year for 2 years in succession. And depending on all these answers, they arrive at what is an appropriate investment option for you. And the appropriate investment option would then have a mix of growth assets and defensive assets. A common example is a balanced option, which probably has a 60-40 split, a 60% allocation to shares and 40% to things like asset classes like bonds, fixed interest, cash, etc. The more aggressive ones, when you have a longer time frame of greater than 10 years, are options like growth and high growth, which have probably 75 and 90 to 100% in growth assets. Where the higher you have in growth assets, the higher is the volatility. In recent last 1 month, anybody in a high growth option would have experienced one day up, one day down, like a yo-yo. Okay, and you must be comfortable with that. There are some people who call me and say they've not slept well. Then you shouldn't be in that option. Now, you should be in an option which you are comfortable with the risk you're willing to take and the return you're seeking. If you say, I want a double-digit return and I want no risk and I want to sit in cash, cash in the past, a few years ago, used to produce virtually nothing. Currently, it does produce maybe 4-5%, but definitely not double digits. And if you want to a double-digit return and you sit in cash, you're simply dreaming. It's not going to happen. You got to be willing to take risk, and you got to be in pursuit of seeking higher returns, and you got to accept volatility. If you're not willing to accept that at the highest level, you can have it at a moderate level. But changing or switching an investment strategy because your balance has dropped is probably not the right option, because the recovery comes. And when the recovery comes, you have switched and gone to cash and you get cash rates. You do not get the same recovery that others would continue to get in a growth option. So therefore, my sort of advice to you would be, you should be in an option which you are going to be comfortable with, you are for the return that you're seeking and the risk you're willing to take. This topic, nobody has a crystal ball and nobody can predict and tell you which is the right option for you. The advisor or somebody, you use tools which help you to make that decision, and you got to stay by that decision. You got to stick by that option through thick and thin. A risk profile analysis is key. So I encourage you to check the option that you are in open your statement or go online and understand the risk you're taking, the return you're getting, and see if that's appropriate for you. We will take some more questions later on that topic, I'm pretty sure, but I think we will sort of on investment options close there. The last two things that I want to talk about is I often get the question as how much super do you require for a comfortable retirement? Okay. Well, it is really dependent on your living expenses. I meet barristers and lawyers whose living expenses are very high. And well, obviously, if you want more than 100,000 as your living expenses, you need to have a bigger nest egg. The Association of Super Funds estimates that a couple needs about 73,000 for a comfortable retirement per annum. This is without any debts and without any dependents. The children have left home and you have no mortgage left. Okay. And to generate this, they estimate that you need about 690,000 to 700,000. This is a fact which is also complemented in this lucky country that we have the age pension. If you have lower assets, you get a bit of the age pension. At this asset level, the age pension currently cuts off at a little over $1 million. And to those who do not know, the age pension currently, the full age pension for a couple is $45,000 per annum. For a single person, it's about $30,000 per annum that the money the government gives you when you do not have any assets. So the retirement is income is earned from a combination of your super savings and a bit of a handout on form of the age pension from the government. I do not encourage you to wish and bank on the age pension, but be aware that it is there as a supplement to complement your own income from super. I talked about saying about closing with some strategies to grow your super. And the main one to talk about is salary sacrifice, which is putting voluntary contributions into super. Voluntary contributions are, as the word suggests, voluntary. It's not mandatory or required, but it has two advantages for you. It helps you pay only 15% tax on those voluntary contributions into super rather than your marginal tax rate, which may be, as in most cases, on a wide band of 45 to 135,000. That tax rate is 30% plus Medicare. So you save 17% tax by putting it into super. You also help to build your nest egg, and the earlier you start it, as I said earlier in the presentation, it compounds and earns interest on interest. So therefore, if you're able to start it earlier, I know I myself have been in that situation. When we are a migrant, you have to save towards your mortgage, you have to spend towards education expenses. So I would encourage you to see what your cash flow affords and start small. $50 a fortnight, $100 a fortnight also helps. But keep in mind, there are two disadvantages. Money put into super results in your net take-home pay reducing. So you must have enough to meet your living expenses. And the second one is the point which I sort of said earlier, that money put into super is preserved, is locked, and you can't access it till you are 60 and retired. I think we're about time as to where I should stop. And rather than me lecturing on this topic, try to take some questions and help you to get some answers to what you really want to get out of the session. So Surya, can I sort of say, we'll stop there and take questions.
No, thank you so much. Very condensed, very wide variety of topics you have covered. Thank you so much. And I'll start with few quick questions. I can ask two questions straight away. Is one is what are bare minimum compliance requirement for SMSF in terms of audit? And the second question, I was confused that you can make $30,000 contribution, or rather, what you're saying is that it's a difference of what his employer has already paid. For example, 12% minus is deducted from 30,000 limit. But yeah, that was a confusion. So two questions from me.
Yeah, thank you for those two questions. The first one is a little bit, I have not been an expert in SMSFs and have never advised on SMSFs, but the basic compliance is that a super fund has to have an investment strategy, invest according to that investment strategy, complete a tax return regularly in a timely manner. A lot of funds do not do their return, and then obviously if you've not done your return, you're non-compliant. So audit and accounting are also key in sort of valuing assets. People have various types of assets, cars, collectibles. proper valuation are some of the things that would ensure that the fund is compliant. Um, the second question about the limits. Yes, the concessional contribution limit is 30,000, which includes the employer contribution. But there is one additional thing that you can do. In the past 5 years, if you have not used your limit to the full, like you are only not doing any salary sacrifice, just doing, say, the same example, 100,000, you were using only 12,000, the difference is not lapsed or lost, it is carried forward. So you can use some of your past years' unused concessional contributions in future years. The best place to find this information is on your MyGov account, which has a listing of the limit that was there for each year. The limit was also different. It was 25,000 in the past. It became 27,500. It is now 30,000. But it gives you a listing. It calculates everything. It calculates how much was contributed and how much is unused. So if you're looking to maximize now that your cash flow or your situation has changed, this children's education has been completed, the mortgage has been brought to controllable levels, and you can put your foot on the accelerator, then review your past unused concessional contributions. That can take you well past, if it's for 5 years and you've not used maybe even 15,000, 15 into 5 would give you 75,000 more of additional contribution. But the best place to check that is your
In the
MyGov.
MyGov, yeah. So if I make $30,000 contribution, I can get, even though it's a tax paid money, I'll be putting in, but my this year's financial year's tax return, it will reduce my taxable income by 30,000. Is that what, by paying 15% only on that amount?
Yes, you will
Okay,
pay 15% and you'll get to claim the deduction and it will reduce your taxable income.
thank you. I will encourage all the audience to raise your hand, or if that option is not visible or clear to you, you can unmute and ask your specific question.
Thank you so much, Benjamin, for such valuable information. I had a question. If you are starting your own journey in your career as a small self-employed person, then how do you choose which super is right for you?
You mean which super fund?
Yeah, which super fund is right for you? How do you choose that? How do you know that? What are the elements that you need to look into in order to understand?
Okay. So yeah, I get this question often, and even when I'm talking to non-members who wanting to join the fund. So there are basically three parameters to look at to try to evaluate which fund is the most appropriate. The first is fees. So shortlist a few funds and determine what are their fees. The second parameter is performance, how they have performed in the recent past for various investment options over various periods of time frame. And the third would be service. If your service is important to you, some of the information that you don't know on super, and if somebody is going to help you to do salary sacrifice better or to structure your nomination or your insurance, then the service that you get is another factor. So those,
अभी कर दिया है ना हाँ
Sorry, I'll mute 1 second.
sorry. Yeah, so answering your question, those are the three factors: fees, performance, and service would be the factors to take into consideration. Now, performance is again very hard to evaluate because various tables show over 1 year legal super may be better, over 3 years uni super will be better, over 5 years Australian super is better, over 7 years a third fund could be better. So the government, again, has done some of these comparisons on your MyGov. You can choose a short list of funds and compare funds on MyGov. So you can see what is the fee structure that they have, the performance that they have done. The service component is probably not there. So on MyGov, if you say compare my super, you select a few funds that you think you are likely to be looking at. The comparison is done for you for these parameters of fees and performance.
Okay. Yeah, that is something I need to look into. I have very recently started my journey, and let's see, I might have a personal conversation with you if I get confused.
Yeah, no, but more broadly than that, most funds performance and service is pretty similar. The key for you is that as a self-employed person, there are times when you will not have such a great year and you may not make any super contributions. There are other times when you can have a great year and you're going to end up paying a huge amount in tax.
Yeah.
So that is the year which you can choose to see that if you wish to make the higher contributions, and if you're not done for the previous year, use the catch up and things like that. So those are, rather than just the fund, the individual strategy for your situation would probably be more relevant to look at rather than which fund. Most funds are pretty similar. So you would, irrespective of which fund you end up with, you should be okay. But your individual strategies would make a big difference
Okay.
because
Yep.
your income is relatively fluctuating. An employee, okay, it rises very smoothly, but yours is any self-employed person is likely to fluctuate a lot more.
Correct.
Thank you. I think we're conscious of time, so I'll request all audience to ask more questions. Keep your questions precise so that more audience can ask questions. Thank you, Srilekha ji. Vimal ji, yes. Then Khagesh ji.
Mr. Benjamin, I just have a quick question. So, beneficiaries who are entitled to receive a benefit after the death under the superannuation law, such as adults, children, so those who are not financially independent, so either there is a tax benefit. So in that case, can you please highlight? So those children who are major or adult can get some sort of tax benefit after the death of a children. Because say, recently I come across this type of situation where there is a tax element is coming for the adult children who are beneficiaries. So there is a tax amount of 70% and 32%. So in that case, whether the wife, I think this is a tax free. Can you please highlight on this?
Yes, so let me explain to you. Your super comprises of a taxable component and a tax-free component. The
Correct.
employer contributions, the salary sacrifice, and the earnings all go in a taxable component.
Correct.
Money paid from an after-tax from a bank account where tax has been paid on and contributed into super
Yeah.
goes into the tax-free component. So at any point in time, your super has a taxable and a tax-free component.
Correct.
At the time of death, the taxable and tax-free component, if paid to a wife, spouse, de facto, interdependent, is completely tax-free
Correct.
to this person. If paid to adult children, the tax-free component is paid tax-free. The taxable component, if from a taxed fund, like an industry fund or a retail fund, attracts a tax of 15% plus Medicare, which you rightly quoted the number 17%. So that is on the taxable component. The 32% is for untaxed funds, some of the government funds, which are very rarely seen. But the most likely tax will be the 15% plus Medicare. Now, how to avoid this tax? There is a strategy. So basically, when you turn 65 and are retired, or even before, when you are eligible to take money out of super, it is called a withdrawal and recontribution strategy. As I said earlier in the presentation, you are allowed to take money out of super completely tax-free when you are over 60. So you take almost the whole balance out.
Okay.
You have it paid into your bank account and then put it back in. When it goes back in, it goes into that tax-free bucket.
Okay.
And thereafter stays in the tax-free bucket, accepting the earnings. And if you convert it into a pension, the ratio or the split is locked.
Okay.
However, there are some limitations with the strategy. You can take unlimited money out, but the amount you can put in has some restriction. The amount you can allow to put in is 120,000 a year, and you can bring forward to future years and make 3 times 120,000, which is
Yeah.
360,000. So if you have $1 million and you're trying to adopt this strategy, it probably will not allow you to put the $1 million back. But if the balance is only about 360,000, then you can withdraw the whole thing, leave $1,000 to keep the account open and put
Yeah.
it back in. It will go into the tax-free bucket. And thereafter, if paid to adult children from the tax-free bucket, there is no tax for them.
Great answer. Thank you so much.
Very interesting. Thank you.
Yeah, yeah.
I'll-
Another quick question is if the person is not employed and he has a income protection under this super, so whether he can get this benefit or no?
Unemployed doesn't qualify for getting income protection.
Okay. Okay.
Even that, I think I mentioned that if you resign or are
Yes.
are terminated, the benefit is for not able to work as a result of illness or injury.
Okay. Thank you very much.
Yeah, it was a new information for me as well. Yeah, thank you. Kageshji, over to you.
Can you hear me? Hello?
Yes, we
Yes.
can. Yeah.
Hi. A couple of things. One, you mentioned on Sri Lekha's question on how to select was basically fees, performance, and service. I think the fees is probably the only clear thing that you can see on the MyGov comparison list. Performance also you can see very clearly. So if you are looking at long-term performance, it might be good to see a 5-year or 10-year performance rather than 1-year performance. This is just my suggestion and comment. And for the service, I'm a little doubtful on how can one judge the amount of service that is available from super funds till you have actually conscribed with them, or till you have actually put your deposits with them. So if you could explain that, how to evaluate service. The second part was, I am 73, and if I use the strategy of withdrawing all my super to take care of all the taxable component, up to what age will I be allowed to put in at the rate of 120 or 150 per year back into super?
Okay, good questions, and thanks for explaining and clarifying those comments on MyGov. You're absolutely right that fees and service and performance are only shown there. I'll answer your second question first, and it's a very simple and straight answer. You're allowed to make contributions into super up until age 75. Okay, that's when the door closes, and only the downsizer contribution from a sale of a house is the only contribution that's allowed beyond age 75. So all concessional, non-concessional contributions, you can be 74 and still use the bring forward of 2 future years. So at age 74, you can use that year's 120,000 and the 2 years later years, even if you're over 75, provided the contribution is done before your 75th birthday. So answering your question, age 75 is when the cutoff is. I'll come back to your first question about service. And you sort of partly answered your own question. Well, the proof of the pudding is in tasting it. Okay. So so I will give you some tips as to how to make an evaluation on that. The ideal one is an experience of a friend or a recommendation from a friend or a relative who has experienced the service. Okay, that is a big tip as to you have not experienced it, but there is somebody who has experienced it and vouching for it. That is, they have eaten the pudding and they have tasted it and they say it is nice. The last one I would give you a tip is that try to look for funds, which a lot of the industry funds offer you free advice. And free advice, if offered, it may come with some constraints that it may be just a single topic and you may have questions only on one topic. But I worked for many years with Vic Super for 15 years, and we used to produce a statement of advice for every single person that we saw, and every bit of advice was completely free. So if you can find and get a fund of that nature that provides you advice free, that is a service which is invaluable. They cannot put a dollar value to that. I would encourage you to currently not too many funds offer that. They do offer free advice, but they offer it only on one topic. So you have to choose a topic on which they don't offer you a comprehensive retirement plan.
So is that free advice service tabulated in the MyGov comparative lists?
No, unfortunately not.
Oh, it is not mentioned there. Okay.
No.
The other thing that came to my mind, and that I could also suggest to Sri Lekha, is uh, I don't know whether the comparative list mentions the options you have in each fund to be able to select. Most of these funds nowadays uh, give you the choice of taking a defensive or a aggressive or a balanced option. But do they also offer you wrap options in terms of 8 asset classes, or you can select how much percentage you want to put in each asset class based on your feeling of how each asset class may be performing in future?
Yes, so the MyGov site does not provide you the decision as it is. There are too many variables. I give the variable of 1 year, 3 years, 5 years. If you add the variable of the investment option, one fund, you can't compare one fund's balanced option with another fund's high growth option. That is not comparing apples with apples. So the comparison on MyGov is done on every fund has to have a default option, which is the balanced option usually. And they make a comparison on a like-to-like basis with assets similar in the range in a balanced option. So all comparisons are done on the My Super balanced option of a fund. They don't compare all the options. There'll be just too many, and it'll
Yeah.
make the decision complex. It won't help to you to make the decision.
No,
So
sorry. What I actually was asking was, you have either balanced, defensive, or aggressive options, which are three options, or some super may offer you a selection. You select how much percentage goes into 8 or 9 classes based on your preferences. So then you know that one only gives you three options of balanced, aggressive, and defensive, or another one offers you 8 or 9 different options, which you can select a certain percentage of how much do you want to take from each side. So is that information also available on MyGov comparison, or that
no,
you
the
have to
MyGov
check?
comparison is only on the default option, the My Super Balanced option. You're very
Okay.
right in saying that the choice of a fund should offer as many options. A very
Yeah.
simple and straightforward sort of structure of options are the cash option is the lowest risk option. It has 0% in growth assets. This usual increases in the increments of 20%. The next option has about 20% in shares. People call it various names, conservative, whatever. The
Yeah.
next one has 40% in growth assets, usually called conservative balance. The next one has 60% in growth assets, which is usually balanced. The next one is the growth option, which has about 80% in growth assets. And the last one is high growth, which has 100% in growth assets. So you can see that the increments are in the region of 20%, and it keeps stepping up in the growth assets. And you then choose which one you want to be in. The default one on which most comparisons are done on the MyGov site is the My Super balanced option. And it is only the easy way to make a comparison. Otherwise, comparisons become just too difficult. I forget for a layman, even for a financial planner, it's difficult.
Yeah, that's right. Yes. Yeah. Yeah. And yeah. And okay. And thanks so much for letting me know that important information regarding. Just to reconfirm, that means if I still have 2-3 years uh, to be able to take out super as my pension and then recontribute it up to the limits of carry forward. So in my 74th year, actually, I can do 3 years carry forward, which means I have about 4 years still available, 4 years of, and the non-concessional limit is 120 or 150,000 now.
120,000 now.
120, and it is proposed to be increased every year, or it is
No,
fixed at 120.
it increase. See, the increases is dependent on CPI. It is 4 times the concessional contribution. So I said earlier the concessional contribution was 30,000. 4 times 30 is how the 120 figure is arrived at.
Yeah.
And when the 30 increases, it may jump to 32,500. It's usually in increments of 2,500. That's how it has happened in the past. It started with 25, went to 27,500 and to 30. The next one would be 32,500, and the non-concessional would be 4 times 32,500, probably next year.
All right. Okay. All right.
Thank you.
Thank you so much. I
Thank you,
really
Kageshi.
appreciate that information. Yeah.
There are two questions in the one question in chat from Biren Joshiji. Do you want to ask, or I can ask on your behalf? So question is, if a person can make contribution up to age 75, does the person have to meet the work test?
Oh, yeah. Yeah. That was important.
So there are two types of contribution. For the contribution that we talked about, the non-concessional contribution, you do not have to meet the work test. If an employer contributes, that's obviously you're already working. The person like Sri Lekha, who's self-employed, has to, after age 67, meet the work test for a personal deductible contribution. For a non-concessional contribution, where it's just for the recontribution or putting money from after-tax money from a bank account into, or sale of shares or sale of property into super, there is no work test.
Thank you. And
Sorry, yeah, just because I think there was some stoppage on my video. I missed out to some part of it. So you are saying for non-concessional contributions, there is no work test requirement.
Correct.
Okay, wonderful. That's good.
Thank you, Kageshi. And I'll encourage more audience to ask questions. I'm conscious of time. Anybody has got more questions to ask? Yep, Pallavi Babi. You can unmute your unmute, Pallavi ji. Yep, I've requested you unmute. Yep. And meantime, yeah, more questions. Yeah, Anoop has asked this. While Pallavi Babi, you need to unmute. Let us know when you can unmute. But the question on the chat is, does all assets need to be valued at the end of every year on SMSF? Would
Yes. So basically, an SMSF has to do a tax return every year. For the tax return, you need to list the assets. And to arrive at the return, the tax of the SMSF, the sale of assets that has happened, what has been the gain, and if it is property, a valuation is required to determine what is the value of the SMSF at a point in time. Now, who does the valuation of the property? See, the property valuation is very rubbery. Like, it is not an exact figure. It really depends on the day when actually the property is sold and who is the person in the market. So a valuation from a real estate agent is acceptable. Some say that even a council valuation on your council notice is acceptable, but if you consistently use the same valuation, so if you're using the council notice, then you should use it every year. You can't use 1 year this and 1 year another method or things like that. So yeah, answering your question, who can do the valuation? You can get a valuation just done by a real estate agent. After all, it is an approximation. It is not a set figure, and it is just for the purposes of determining the value of the fund. And it is the final figure that matters is if the asset is sold. Those assets have to have a definite figure. There has to be gains, there has to be taxes on that. So that figure for any asset sold is a certain figure. The evaluation can be done by an estate agent or even the council notice.
Thank you. Question from Pallavi is on how do you see effect of sorry. Yep. How do you see the effect of current global scenario on superannuation around the share market happening? So as I think during the presentation, you already said you don't need to panic. But if I can combine my question there is that when you say that we need to choose different strategy of balanced versus high performance and all, how often do you need to review that once you set and forget for a few years, 5 years, 10 years, or how does that work, the review of your investment? Or can you change it every 6 months?
Superannuation is a long-term investment, and therefore the planning and the strategy should be a long-term strategy, especially if you are in the first phase of your career. By first phase, I mean between 20 and 50 years, the strategy should not be tinkered or altered. You arrive at whatever you want to have as a strategy and you stay with it. and towards the end, when you are planning for retirement and at least 2 to 3 years before retirement, it requires close monitoring. You cannot be in high risk assets at that point in time because the point in time at your retirement is the time when you have the highest amount and after that you start drawing on. So that's like it's like a mountain. You climb, you're at the peak, and now you're going to go down the other side. So that requires definitely a review. What I do not encourage is probably trying to time the market, but I'm guilty of it myself, and I've seen others do it also. But you try to do it before the changes happen. If the market volatility when the GFC happened or when COVID happened, and there were drops or losses of 20%. After that, if you try to switch and say, I'm not sleeping well, I have lost too much, that's not the time to change. Even in this current market volatility, most commentators tend to think that we are still not even given up the gains of this year. From July to December, there were substantial gains. We have given up some of our recent gains, but we are still ahead of what we were at 30th of June. So it's still appropriate if you want to jump, or change, it is okay because you're not lost, you've only given up some of your past gains. But it's again, there's no real science that people said when Russian war started 2 years ago, markets would crash. Another war started when Israel and Hamas started something and markets would crash. Nothing happened for 2 years. They just kept galloping up. Well, what can happen in the future, nobody can say right now, but it is still not, yes, if there is talk of likely to be a recession, some of the tariffs are going to be damaging for economies like Canada and things like that, and even the American economy. So if you're agreeing with some of those theories and fear a recession, then you should scale back risk. But I cannot recommend that to you, and you are the captain of your ship, and you're doing it in the context that your view is that it is going to result in dropping from now. That is, if you are convinced with that and that's your firm view, then that is your decision.
Thank you.
There's a question about, do you recommend e-super fund for self-managed super fund purposes? Yes, I have reviewed and sort of done a comparison of various super funds. And in my comparison, e-super fund is very competitive in their price structure. You got to be completely hands-on. They expect you to do all the work. You got to do a checklist and fill in every single data. So if you are a person who's competent to do that, then you can use e-super fund. But if you are likely to be not very capable of doing it and would like to seek help from an accountant, they give you no help whatsoever. So it is a complete do-it-yourself activity. So answering the question, do you recommend e-super fund? It is, in terms of price, very competitive and among the cheapest. But it is hands-on and you have to do all the work yourself.
Thank you.
Can I ask regarding this e-super fund? What you're saying is basically their rates are competitive, but they only do the administrative part of the SMSF, or do they also offer SMSF advice on procedures and regulatory requirements?
They do the administrative part, they do all the accounting, they do all the auditing. As a trustee of the fund, it is your responsibility to ensure that you adhere to all the rules and regulations. If you are in doubt, they will clarify the rules for you. And before doing anything, if you seek their help, they will give you a yes, no answer that you can do this or you cannot do that. But they will not, if you don't ask them, they will, and if you have done something wrong thereafter, that they will not be able to advise you on. So they do the admin, they do the accounting, they do the audit, and they give you help if you seek an opinion. And it has to be a very close-ended question with a yes, no answer.
Yeah, what I meant was people confuse advice with advice on where to make investments, or the advice can be just to understand the regulatory requirements. So, as long as the questions relate to advice on regulatory requirements and procedures, they would be able to answer. Is that?
Yes.
Yeah, okay, great. Thank you.
The advice is not so the principle and the concept of a self-managed super fund is you are taking not just to be the captain of your ship, you are taking to be the sole and ultimate control of the whole ship. And the investments are usually in property and shares, which, like, uh, you decide, and you don't have like you don't need too much of input to that. You just need to ensure that when you sell, you have the right sort of documentation and things like that. So answering your question, they will provide you regulatory advice if it is in advance that you seek it.
Okay.
We are 7 minutes over. I may take one final question if Benjamin permits.
Yeah, over it.
Anybody wants to ask final question before we wrap up for tonight?
Silence. Any comments that you learned something that you did not know today?
A lot,
Yes,
Good.
yes, we did. Yes.
a lot. Thank you.
Thank you
Thank
so
you
much
so
for
much, sir. It was an absolute pleasure to have you on board with us.
So so Benjamin has put his profile in the chat. So anybody who wants to learn and know more about Benjamin, you can visit that link in the chat.
No, that's more than that. So let me just clarify, Surya. So that's basically the fund, as you said earlier, that I work with is Legal Super. And we offer a free service to help you and advise you. And that link is to make a booking, which will take you to my calendar and see a mutually convenient time that's available to both of us. The session is completely free and complimentary at no cost and at no obligation. Can't
Oh,
get better than that.
oh, that's so kind. Thank you so
So much,
much.
sir. That's very valuable. Thank you.
So I'll encourage you all to check into the chat. Otherwise, I'll put it into WhatsApp group as well. I've also shared a link on how to join the WhatsApp group. Those from the audience who are not on our WhatsApp group for notification. It's an admin only group where I only post messages, so you'll not see a lot of noise there. So join WhatsApp group. I'll post this link into that chat as well. So
So today we covered superannuation. Surya, if there is interest, maybe in a month or 2 months, we can do the pension side of things as well. If
sounds
you
really
get some
interesting.
feedback and response, if it takes, give it a break, and maybe in 2 months' time we could
Correct.
cover.
Yeah. Yeah.
Today we covered accumulation. We could cover the pension and Centrelink.
Yep.
Uh,
Sounds really
do you also help with estate planning?
In what
Thank
respect?
you,
With
sir.
regard to super, yes.
Yeah, super related, because as I understand that, you know, like, I mean, a typical question that comes at people of my age is, if money on super is given to independent children, senior children, there are tax liabilities, while if it is outside of super, it can be gifted, or it can be considered as what do you call hereditary, inheritance, which is not taxed. So
Yeah, no, we can talk about it. I am a certified financial planner. I have the highest qualification. I can tell you the rules, but I operate under a license of a super fund. So I can only cover super assets. I can't give advice on non-super assets.
mhm.
And I can tell you the rules, and then we can see what we can or cannot do in that meeting. But I want to wish to clarify that I have the highest qualification. I know the rules, but my license will permit me to only talk about superannuation and superannuation related matters.
Okay, all right. Thank you so much for letting us know, and really appreciate. We're surely going to be connected. Yeah.
Yep. Benjamin, you have lots of lawyers and barristers as your client. Would you recommend somebody to give community education webinar on wills and power of attorney? That is my area of interest as well, that many people have not defined their wills and some initial guidance on why it is important, what are critical things to discuss during wills and all, and then possibly some referrals on what services can be used, basically. Would you be kind to find some best speaker on the area or subject from your potential,
Yeah,
from your
I do
clients?
have a couple of names that come to mind straight away, but I will speak to them and get back to
And
you. I will
get back to
first
me,
check
and
with
then
them.
when in a couple of weeks time, if they can do small fluid webinar like this, where 20 to 25 minutes they speak on what are basic structures and important aspects to think, and then and basically towards the end people can ask question and answer.
Yeah, I'll get back to you with a couple of names after I speak to them. Thanks.
Yep, thank you. Bimalji also recommended to refer few, so we can see who is interested on short period of time, and then we can have multiple webinars like this. And as you said, you will have another one, so we can have multiple sessions on various aspects of wills in coming months as well. So yeah, please refer both of you. Thank you. So with that note, thank you so much, Benjamin, for tonight's webinar. You have given us lots of insight, and I encourage community to appreciate and participate in these webinars. I'm conscious of timing. It's 9 to 10. It's late in the evening. But as an adult, as a grown-up, this is time we have no distraction. And these webinars are recorded and put it on YouTube. I post the summary recap of these webinars on LinkedIn, Facebook, and YouTube and WhatsApp group. So please do subscribe, like, and share with the community. With that note, thank you so much, Benjamin, once again, and we'll meet you again in next webinar.
Thank
All right.
you. Good night.
Good night all. Bye.